Alright, so this is gonna be a super quick video to answer one question. How does private equity actually work? What's up everybody? It's Guys here, and although I don't usually make videos this short, considering this is a topic that's been requested non-stop for the last month straight, I figured why not take a few minutes of your time to explain exactly what private equity is, how it works, and hopefully by the end of the video help you decide whether or not this is something that you want to pursue. If you have no idea what private equity is, that's okay. Just think of any company that you know about: Apple, Google, Facebook, Tesla, Nike, Amazon, whatever comes to mind. Now imagine if each one of those companies had a secret owner who owned just enough of the company where they could control who sat on the board of directors and influence major decisions at these companies, like whether they should fire their CEO, approve of new projects, or even sell the business outright. Well, in theory, this is the type of power that private equity firms and investors can obtain when they invest into a company, except instead of investing into publicly traded businesses, they buy them, and since they're not required to disclose anything to the public, they're able to operate with very little oversight. Now, before we go any further, I do want to say that private equity isn't for everyone, but if you're someone who likes taking calculated risks, being in control of your own destiny, and doing work that has a direct impact on the success of a business, then stick around because there's a chance that this might be a career path for you. So first, let's address the elephant in the room. What's the difference between private equity and venture capital? Well, there is really three main differences, and probably the easiest way to understand them is by thinking about what type of companies each one invests in. Private equity buys existing companies while venture capital funds startups. A third category called growth equity kind of splits the difference by investing into both existing profitable companies looking to grow, as well as newer businesses who have turned a profit but are expected to become cash flow positive in the near future. Generally speaking, private equity tends to focus on later stage companies with proven business models and strong cash flows, whereas venture capital tends to focus on early-stage companies who need more guidance, and growth equity sits somewhere in between. Second, the way that these companies are valued is quite different. Since private equity targets later-stage companies, they tend to have more predictable cash flows, which makes valuing them much easier. On the other hand, venture capital investments are extremely risky, which is why they use a discounted cash flow analysis, which is very similar to what we've talked about in previous videos. And finally, the amount of money invested also varies quite a bit. Usually, private equity firms will buy out an entire company for hundreds of millions or even billions of dollars. Growth equity often invests alongside the company during a specific round of funding, so the amount invested is going to vary based on the round. Venture capital, on the other hand, tends to break down into smaller investments across multiple rounds, and generally speaking, the earlier the investment, the smaller the check size. But now that we understand the basics of private equity, how does it actually work? Alright, so let's pretend that you are an investor who has $1 billion to invest into a brand new fund. That fund would then go out, find a company to acquire, and buy of that company for, let's say, $400 million. This means that your $1 billion fund would be invested into a portfolio company, which could then go out and use that money however they wanted to. They could buy back stock from shareholders to go and do a bunch of research and development, hire additional staff, or open up new facilities. Then after 5 or 6 years, they would eventually sell the business for hopefully more money than they bought it for, and after all fees are said and done, your fund would distribute the remaining proceeds back to investors like yourself. And when I say fees, what I mean is that the private equity firm itself gets paid a management fee, usually a percent of the total capital raised each and every year, regardless of whether or not the fund makes any money. On top of that, they also get carried interest, which is a percentage of the profits that the fund generates. Usually this comes out to around 20% of the overall returns, though it could be higher or lower depending on the terms of the fund. Now, I wouldn't necessarily say that this is fair, but this is the industry standard. And the way that they justify this is by saying that they are taking on a lot of risk, they are putting a ton of time into sourcing and vetting deals, and they are typically investing their own money alongside yours, thereby aligning their incentives. Alright, so now that we know how a private equity firm operates, let's walk through the entire process step by step to see how it actually works. The process begins when a company decides that they want to be sold. This could be for a multitude of reasons, but usually it has to do with either the owners wanting to retire or the company needing extra capital to continue growing. Either way, once the company is ready to be sold, they'll hire an investment bank to handle the transaction. That bank will then reach out to their network of contacts to gauge interest, and if enough people are interested, they'll send out marketing materials to kick off the auction. As a potential investor, you would then look over these materials, which include financial projections, industry research, a list of comparable companies, and everything else the bank thinks is relevant. If you're interested in making an offer, then you'd submit a preliminary bid, which would then be followed by a beauty contest, where the seller chooses who they want to move forward with. The next step is due diligence, where you have got the opportunity to poke holes in the business and determine whether or not it is worth buying. The seller has to provide access to pretty much everything during this phase, so it's not uncommon for buyers to bring in outside professionals to review legal documents, environmental compliance, litigation history, pending lawsuits, and literally anything else that could help justify the offer. After due diligence is when the deal is officially signed and the money is exchanged. The buyer takes over operations and tries to make the company as profitable as possible. This could entail firing the old management team, hiring a new team, cutting costs, increasing prices, developing new products, expanding internationally, or really anything that the buyer thinks will increase cash flows. After 5 to 7 years, the company is sold again, the proceeds are distributed to investors, and the entire cycle starts anew. Okay, so obviously this is a massive simplification of what actually happens, but that's the basic idea. You pool your money together with other investors into a fund, which goes out, buys a company, improves the business, and then sells it for a profit. That leads us to our next big question, which is how much money can you actually make? Well, it's really gonna depend on a lot of factors. For starters, the type of fund that you invest in matters. Large funds are less risky, so they're going to have lower returns. Small funds have higher potential returns, but they're also much riskier. Second, how much money you make is going to depend on the vintage year. In other words, when you invest during the late 1990s, early 2000s, private equity returns were phenomenal. However, during the 2008 Great Recession, returns took a nosedive. Now, as you would expect, more recent years have seen strong performance, but some of that was driven by the low interest rates that we saw during the pandemic. Third, your individual investor returns will depend on what fund you choose. Some funds outperform others, some funds underperform, so it's important to do your research and pick wisely. With that said, it is not uncommon for private equity investments to generate annualized net returns of anywhere from 15% to 20%. Now, keep in mind, that's net, so after all fees are taken into account. This is also only after investments have been fully exited, so it could take years before you see any sort of return. Also, not all investments will perform the same. Some will do better, others will do worse, so it's important to diversify your holdings and invest in a variety of funds. Finally, let's address the elephant in the room. Is private equity worth the cost? Are they overpaid? Do they add value? I personally believe that private equity does add value, but it's not always worth the cost. Typically, if a company has good management already in place, they don't need to get acquired. Why give up a portion of your company, pay hefty acquisition costs, and take on debt when you don't have to? However, if a company is poorly managed, has a bad corporate culture, or simply needs some extra capital to continue growing, then it could make sense to partner with a private equity firm. They could inject the capital necessary to grow, they could take an active role in improving operations and management, and if done correctly, The company will be worth a lot more at exit. So with that said, you're now an expert on private equity and how it works. You're welcome to stay tuned for more content just like this one. Thank you so much for watching. Don't forget to subscribe and until next time.